Hello guys, here with you Anna Tutova, co-founder of Coins Telegram, and our guest Brian Quintenz, who is a former US CFTC Commissioner, and currently he is head of policy at a16z, leading a venture capital company, and as well last year they announced the biggest crypto fund ever in the industry of $4.5 billion. Great to have you here, Brian.
Thanks, Anna. It's great to be with you. Thanks for the invite.
Yeah, so you've been quite a long time crypto advocate, and so you served in CFTC and pushed crypto regulations there before. So when and how did you discover crypto first, and how did you perceive it first, and whether your view on it changed within the time?
Yeah, thanks. So my first exposure to crypto was when I was in the financial markets before my time at the CFTC. I worked at a hedge fund that was focused on the banking sector, and that's not necessarily completely relevant, but in working at that hedge fund, I was exposed to a lot of news flow. We had a Bloomberg terminal, and so we see a lot of headlines, and I was trying to keep up to date on the markets and innovations. And I saw the development of Bitcoin, some of its uses, some high profile people advocating for it and investing in it. And so I took note of it at that point, although that wasn't necessarily my focus at that point. I was more focused in the traditional financial system and the traditional investment space. As I progressed through my career after that, I started becoming more aware of crypto, although it wasn't something that I prepared much for when I was being considered for the role of commissioner at the CFTC. I was mostly focused in that nomination process on the Dodd-Frank law that had been passed by the United States Congress and signed into law by President Obama as a response to the financial crisis. And so I was more focused on legacy regulatory rules of how to regulate the swaps market, for instance, which was one of the big pieces of jurisdiction that Dodd-Frank gave to the CFTC. However, when I first joined the CFTC as a commissioner, within about 3 or 4 months, two of the largest derivatives exchanges in the CFTC's purview listed and self-certified Bitcoin futures contracts to trade. And that event basically, I think, put the CFTC front and center in the intergovernmental debate around crypto and the market debate, the TradFi debate around crypto, and squarely within the awareness of the crypto ecosystem. And as such, I wanted to spend time learning about crypto, understanding its promises, understanding its use cases. And I think what I saw on a number of occasions was, a dismissive attitude on the part of some regulators or policymakers domestically and benefits of it, or its use, or doubting its potential. And I tried to argue the other side of that. I tried to always take a pro-innovation approach to my time as a commissioner. I tried to recognize that the potential benefits of a technology or an innovation were hard to understand at any given point, and they shouldn't be outright dismissed, and certainly they shouldn't be precluded by new rules that would be applied too early. So that was really, my evolution, and here I am, the head of policy at a16z Crypto, having spent a lot of time and look like the development of Web3. Moving past the centralization and closed system of Web2, changing how individuals can own their digital intellectual property, own their participation in networks, own their digital identities. And I'm more excited about the technology and crypto than I've ever been.
Yeah, and which year first did you discover crypto, you mentioned, when you didn't really pay attention to it?
Where was I when I did that?
Well, you can tell as well where you were, but the question of which year was it when you first discovered crypto, when you found about it?
Yeah, I think it was about 2011, 2012.
Wow, that's
and again,
early.
Yeah, well, it's early to have been aware of it, but at the same time, that wasn't the focus of my then career. I was focused on something else, and so I did become aware of it, but didn't really spend time digging into it and trying to understand it until my role as a commissioner kind of required it. And I'm really glad it did. And at that point, I was also sponsoring the CFTC's Technology Advisory Committee. And I had wanted that role to focus more on legacy technology issues, but again, with the listing of Bitcoin futures contracts and the placement of the CFTC front and center in the crypto ecosystem, I quickly pivoted the work of that committee to focus a lot on crypto. And I think at the agency there, we had one of the most, if not the most, comprehensive set of meetings and policy discussions led by experts in the entire government.
Great. I see you basically just continue to educate regulators on the role on crypto and the importance of its regulations and approaches to the regulations. And recently you released as well an article on the Web3 regulation, and you stated that Web3 regulation must apply only on the app level rather than protocol level. So can you elaborate more on this and can tell you more?
Yeah, and I think that this is based off of kind of, a fundamental view of technology and software and protocol development and its use cases and its accessibility, and whether or not, protocols and software can even comply with jurisdictional requirements and what that would actually mean if put into practice. And so one way to think about it anecdotally is if, a jurisdiction, let's say the United States, was considering or passed a law that banned spam email.
Mm-hmm.
And if they tried to apply that to the SMTP, software, the Simple Mail Transfer Protocol that allows, email applications to talk to each other, it's highly unlikely, if not impossible, that SMTP could accommodate that. And so, it would make sense, though, if that law were on the books, that the regulation could be targeted towards centralized businesses that are providing those apps to access the protocol. And so, one fundamental point to make is that in releasing this kind of idea and putting it out there for public discussion and public debate, we're not necessarily advocating, in that last analogy, we're not advocating for banning spam. We're saying that if a government is going to ban spam, it needs to do it in the right way that's effective and that addresses the risks and focus on entities that can actually comply. And translating that into Web3 and into decentralized finance, if there is going to be a law that regulates crypto trading or trading venues and tries to bring legacy financial regulations or ideas into that space, if that law were to also scope in DeFi, that has to be done in a way that where those regulations can be complied with, and where some of those legacy centralization risks around conflicts of interest, for instance, and record keeping and reporting obligations, can exist and maybe do present risks. And so that's what we're advocating. If a new law is passed to regulate crypto trading and venues, and it's going to apply to DeFi, it has to be done appropriately. It has to be appropriately calibrated to the risks of the entities, and it has to actually target the entities that pose those risks and that can comply with the law. In order for Web3 to reach its full potential, a new regulatory regime is likely needed, and Web3 is going to need DC. That is one of the main focal points of our policy advocacy at a16z Crypto. But it needs to be thoughtful regulation. It needs to be appropriately calibrated, and responsible regulation is going to encourage responsible innovation. And if either of those things don't happen, you're going to get the opposite result. Irresponsible legislation, irresponsible regulation is going to push activity offshore to under-regulated jurisdictions or non-regulated jurisdictions, and it's going to result in irresponsible innovation. So we have to get this balance right.
So how should CeFi and DeFi regulations be separated?
So again, I think it really focuses on, where risks exist, where risk to consumers exist. In CeFi, they're using proprietary software, to execute transactions, right? A lot of those are closed-end systems. They're taking custody of customer funds. There are legacy centralization risks that exist that present opportunities for fraud that unfortunately we've seen in the crypto ecosystem over the last number of months. Although it's not a crypto problem, it is a legacy financial centralization problem that has spilled over into the crypto ecosystem. But I think that those events have likely catalyzed the interest in developing regulations and rules for crypto trading products. How DeFi is different is that it does use open source protocols. They're transparent, they're globally accessible. And at least in this country, there is a freedom of First Amendment speech that encompasses publishing software. However, if you're developing a business, especially one that's for profit, that's providing access and facilitating access to trading services, it's unlikely from a policy perspective that those would be ignored, for the least because of a competitive disadvantage that would be posed to the centralized exchanges that are operating pursuant to a new robust regulatory regime. And so to the extent that a centralized business is providing an app that facilitates trading, maybe some of those centralization issues reemerge that are the basis for legacy, financial regulations. Those entities likely can comply, and they likely should comply with some basic requirements around auditing code to make sure that there's some level of integrity to the protocol to which they're providing access, that they're auditing their own code if they're using and executing, their own, set of software that is facilitating transactions, that they have a risk disclosure so that customers can somewhat be informed on the potential risks of accessing, their application. And so it may not necessarily be the whole suite of regulatory obligations. If an app doesn't take custody of customer funds and is purely just a trading transmission messaging system, then custody rules and regulatory obligations, shouldn't apply. So there likely will be differences, and there need to be differences, but they also need to be scoped to the appropriate entities.
And do you think that CeFi can be just regulated in the same way as TradFi?
So I think that there are some legacy issues that CeFi does present, again, around centralization, around conflicts of interest, around appropriately custodying customer funds, for instance, if they take custody, around record keeping, around making sure that manipulation isn't occurring, that surveillance of their marketplace is occurring, that again provides a market that does have integrity, that people can act within with confidence. So there are some, legacy issues that financial regulation, can build upon for centralized services. However, there are some differences in, these models around custody solutions and around who's allowed to custody crypto assets, and whether or not things like staking is an allowable activity. There is certainly clarity needed around the status of a particular token, and whether or not it is a security or is something that's more freely traded as an unsecurity commodity, right? So there are aspects of centralized financial crypto trading venues that are different and that need new rules and that need to be thought about in a new way. We can't just bring the fax machine era regulations and drop it and apply it to new digital innovation that has the ability to completely create a new model of economic and social function and utility. And so careful thought needs to be given to what legacy financial regulations are important and which new ones do need to be created.
And talking about centralized entities regulation, for example, in TradFi, you need to separate the exchange operation from the custody of funds and etc. So in your opinion, could the SBF FTX fraud be prevented if there were more clear regulations?
Absolutely. I think that there are, especially in the derivatives world, which is the area with which I'm the most familiar, there is a hard and fast rule around segregating clients' assets and not commingling funds. If those rules had been put in place, there would have been a lot of safeguards to have prevented accessing customer funds and using them for the alleged purposes that they supposedly were. And the regulatory regime under which FTX.com operated didn't seem to be sufficient to have prevented that. But I think there's another issue, which is that the lack of a positive and workable regime here in the United States has allowed for and even promoted offshore activity to develop in jurisdictions that aren't as well regulated or even regulated at all. And so if we can build something here in the United States that is appropriately calibrated, to centralized crypto venues, then we can create an environment where people want to trade here within this ecosystem. That activity is brought into the United States or embraced by the United States, and you start to diminish the incentives for builders to develop outside the United States or participants in the US to try to access that development.